There are moments when the elegant models of finance collide with the brutal logic of geopolitics. When that happens, price discovery doesn't evolve, it fractures. A blockade of Taiwan would be one such inflection point, not just for Asia, not just for tech, but for the very architecture of commodity markets. And no asset may reveal that rupture more starkly than silver. Forget the cliches. Silver isn't poor man's gold. It's civilization's silent conductor, embedded in everything from solar inverters and 5G base stations to missile guidance systems and electric vehicle motors. Yet its market is a house of cards built on paper promises backed by vanishing physical metal. Under normal conditions, this illusion holds. But under the strain of a Taiwan crisis, the illusion shatters. Why Taiwan matters, not just for chips, but for silver flows. Taiwan produces over 60% of the world's semiconductors and more than 90% of the most advanced logic chips. A blockade wouldn't just disrupt supply chains, it would trigger a global industrial deceleration. Within weeks, automakers, telecom firms, defense contractors, and renewable energy installers would face parts shortages that cascade into production halts. Silver's role here is indirect but critical. While not a core material in advanced logic chips, which use copper interconnects and silicon wafers, silver is essential in photovoltaic cells, the largest industrial use of silver today, about 110 million ounces/year, RF modules and conductive pastes in smartphones and base stations, high reliability contacts and switches in aerospace and defense systems. Crucially, much of this silver ends up in final assembly, often in China, Vietnam, or Mexico, using components sourced from Taiwan. If Taiwanese output stalls, downstream factories lose not just chips, but the silver-laden circuitry they depend on. The scramble wouldn't be for raw silver ore, it would be for refined bars, grain, and paste that keep assembly lines alive. The triple shock, industrial, strategic, and monetary in a blockade, silver faces a convergence of three destabilizing forces: industrial panic, factories hoard physical silver not as speculation, but as a production lifeline. Price sensitivity evaporates. Strategic procurement, governments, especially the US and China, bypass markets entirely. The Pentagon doesn't haggle over silver zinc battery costs when torpedoes are needed. China's state-backed firms will prioritize silver for military electronics and grid resilience. As great power conflict looms, confidence in fiat currencies, especially the dollar, frays among emerging market savers. In India and Southeast Asia, silver becomes money again, not metaphorically, but functionally. These forces don't merely push prices higher. They break the link between paper prices and physical reality. The COMEX futures market, the supposed heartbeat of silver pricing, operates on a fractional reserve model. For every ounce of registered inventory, there are dozens, sometimes hundreds, of paper claims via open interest. In calm markets, this works because less than 1% of contracts seek delivery. But in a crisis, delivery requests surge as institutional and sovereign buyers demand real metal, not cash settlement. COMEX responds by spiking margin requirements, freezing leverage, or restricting new positions, effectively crushing speculative liquidity. If delivery bottlenecks become unmanageable, the exchange may invoke force majeure or shift to cash settlement, decoupling futures prices from physical scarcity. The result? Futures prices may crash due to forced liquidations, even as physical premiums explode. A price spike on CNBC could mask a collapsing paper market while real silver trades off-screen at 2x or 3x the COMEX quote. London's LBMA market fares no better. OTC bullion trading relies on trust, credit lines, and liquidity, all evaporate in wartime. Banks stop quoting two-way prices. The spot price becomes a theoretical relic, quoted by algorithms with no access to real metal. China consumes 200 million ounces of silver annually, nearly a fifth of global supply, mostly for solar panels and electronics. In early crisis stages, state-backed buyers would flood the Shanghai Gold Exchange, SGE, driving the Shanghai Premium, local price versus COMEX, to record highs. Silver becomes a strategic reserve, not a commodity. But here's the paradox: China is also the world's largest assembler of Taiwan-dependent electronics. If chip imports halt, its own factories slow or stop. Within 2 to 3 months, industrial silver demand could plummet, not from abundance, but from idled production. The Shanghai Premium might collapse, not because silver is plentiful, but because there's no one left to use it. This creates a volatile seesaw, physical scarcity amid industrial paralysis. Prices may swing wildly based on rumors of naval movements or semiconductor inventory reports. What happens to silver ETFs such as SLV? This is where most retail investors get blindsided. iShares Silver Trust, SLV, the largest silver ETF with over $9 billion in assets, holds physical silver in London vaults, audited monthly. Its share price is meant to track the LBMA silver price, adjusted for fees. But during systemic stress, three things go wrong. If LBMA prices become stale or disconnected from true wholesale rates, SLV's per share value becomes misleading. It may trade at a steep discount or premium to actual deliverable silver. Pressures, authorized participants, APs, who create/redeem SLV shares may stop arbitraging if they can't source physical metal or if vault logistics freeze. This breaks the ETF's price tracking mechanism. Liquidity illusion. SLV may appear liquid on your brokerage screen, but in a true crisis, bid-ask spreads widen, and volume dries up. You might own SLV, but selling it at fair value becomes impossible, especially if the US or UK imposes capital controls or trading halts. Historical precedent? During the 2020 market crash, SLV briefly traded at a 3% premium to net asset value as physical demand spiked. In a Taiwan blockade, premiums could hit 20 to 50%, or the ETF could simply stop functioning as a price proxy altogether. Bottom line, SLV is a convenient proxy in calm markets. In chaos, it's a paper claim on metal you cannot access. If you need real silver, you need allocated, segregated, deliverable bullion, not an ETF share. The gold-silver ratio, not a collapse, but a reckoning. Today's gold-silver ratio hovers near 70:1, which is high by 20th century standards, but not unprecedented. A ratio collapse to 30:1 or lower, implying $100 per ounce silver if gold holds at $2,400 is plausible, but not guaranteed. Why? Silver's industrial drag may mute its monetary upside. Gold benefits more from pure safe haven flows. Silver is half industrial, so its rally depends on both panic and production continuity. Still, in a true monetary crisis, where fiat credibility cracks, silver's high beta reasserts itself. It doesn't just rise, it accelerates. And if physical shortages bite, that acceleration becomes vertical. The final truth: you can't print conductivity. You won't be able to buy deliverable silver on COMEX. You won't get fair value selling SLV. You won't find LBMA quotes that reflect reality. What will happen is that silver's true price will be set in private negotiations, between governments, defense contractors, and vault operators, where urgency trumps price. For investors, the lesson is stark: paper silver is a bet on market stability. Physical silver is insurance against its failure. In war, you don't want a receipt for a weapon. You want the weapon in your hand. And in the circuits of modern warfare and peace, silver is that weapon. Don't wait for the screens to flicker red. By then, the reckoning will already be priced, in silence, in vaults, and in the absence of bids you can actually fill. Prepared for a world that's more fragile than it appears. Thank you.